Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, speaking to you here from New York City on the 24th day of April 2018. Before I talk more about today's show, I want to put in a little advertisement for myself. My newsletter can be purchased at miningstocks.com. Jay Taylor's Gold, Energy, and Tech Stocks is the name of the publication. It's published weekly, and then we summarize the month with a monthly newsletter as well, and it's primarily features gold mining exploration companies. And, well, they've not done that great recently, but I think their day is coming, and we'll want to ask Michael Oliver about that in a few minutes, what his thoughts are about gold and gold shares. That's and the sponsors of this show, of course, we want to thank them for making this show economically viable. Our sponsors for today's show are RN Resources, Bonterra Resources, Dynacor Gold Mines, Genesis Metals Corp., Klondike Gold, New Range Gold Corp., Northern Empire, and Novo Resources. And in fact, we will be talking to Peter Talman of Klondike Gold in a few minutes after the first commercial break. I should mention Chen Lin as well, chenpix.com for his excellent newsletter. If you'd like to sign up for Chen's letter, do that. And also send along questions, criticisms, and praises, whatever your thoughts are, to questionsfortaylor@gmail.com. Whatever your thoughts are about this show and any of the guests that you hear, their ideas and so forth, we love to hear from you concerning those thoughts you have. You should know that our sponsors are all by my invitation. It isn't enough for companies to have money to pay for their sponsorship, but I really want to have companies on that I know and like. Companies, in fact, in every case, are companies that I've recommended in my newsletter, independent of whatever they do. After that, I write for my subscribers, companies that I want to own, companies that I want to invest in, and suggest others do the same. Some of those companies come along and they're sponsors, but they are sponsors by invitation only, and I think that's important for you to know that. One of my sponsors that I think the market isn't paying nearly enough attention to is Bonterra Resources, which I have interviewed in the past because I think they deserve much more attention. Last week I did an extra updated interview with Peter Ball, the Vice President of Operations of Bonterra Resources. And this is a company that is in the process of outlining a very sizable high-grade gold deposit in Quebec. It may be one of the highest-grade gold deposits in all of Canada, and it's due to become much, much bigger given the dimensions that have been increased over the last couple of years with exploration. And last week we had some really great news with regard to metallurgy, the ability to win most of the gold from the rock in a very efficient manner seems to be very much in the future for this company, which really adds to the economics of their project, which is also in Quebec, which is favorable to begin with because of low energy costs and infrastructure and everything else that's in place. So you can go to jaytaylormedia.com to listen to my interview with Bonterra Resources. Now, next week, Dr. Quinton Henning of Novo Resources will be with me to give us his update on what's going on there. Well, hopefully there's going to be some assays coming out before Dr. Henning comes on the show next week. That's his view of the Witwatersrand Rand, how it was formed, and that took him to northwestern Australia. So far, the stock has done extremely well, of course, but if indeed there is a real Witwatersrand Rand-like deposit there, there's no reason to think that the shares can't rise much, much further. Well, we'll look for an update with Dr. Henning next week on this show. He'll be a live guest on the show. Of course, Novo Resources has had a lot of attention and some major investors, not the least of which is Kirkland Lake, a company that's put a lot of money into Novo Resources, which has made it possible for Novo to continue exploring what is a very unique deposit, gold deposit in northwestern Australia. You won't either want to miss Peter Talman, who I mentioned a moment ago, will be my guest right after the first commercial break. Peter is the president and CEO of Klondike Gold. That's a company that I also think has a chance to become extraordinarily large. That is the gold deposit there in the process of exploring and developing in the Klondike of the Yukon. All right, well, today's show I've titled Manifest Destiny, Democracy as Cognitive Dissidence. William Engdahl, Peter Talman, as I just mentioned, and Michael Oliver are with me today. George Orwell's famous novel, 1984, is a masterful fictional account of a state which imposes cognitive dissonance on its citizens to control their perception of reality. It is summed up in the statement, "War is peace, freedom is slavery, ignorance is strength." Well, according to William Engdahl, 1984 has been turned from fiction into reality by a bloodthirsty NATO that seeks endless wars and the overthrow of Russia and any other nation that gets in its way of total global domination. So we want to explore some of the William's ideas. Why is NATO so aggressive, and what's behind it, and who's behind it? Will it prevail, and what will be the economic impact on the West and its markets in either event? One thing seems certain: trillions of dollars for killing machines are being spent now and will continue to lead to more dollar debasement, and I suggest a very strong rise in the price of gold as measured in a debased currency. As I noted a few seconds ago, and Peter Talman will be with me just in a minute after our first break, but right now I'm really pleased to say once again we have Michael Oliver. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you almost every week, and we're very thankful that you're willing to talk to us and give us your latest views on some of the key markets. And you cover many, many more markets than we ever discuss on this show, but you hit the big ones for us, and we're very thankful to you for that. And I should tell our listeners it's Oliver MSA, olivermsa.com. Go there to learn more about Michael's work. Michael, there seems to be some consternation in the equity markets now that the 10-year Treasury has risen over 3%. How much further do you think rates can rise before the Fed begins to reverse policy?
Well, I don't know the Fed has any control over anything right now, or the ECB or the BOJ. BOJ still does because their instrument hasn't broken yet. But the bonds, and I'm looking at 30-year U.S. T-bond futures, have blown the utter H out of any structure of support that I can find on annual momentum. And by that, when you look at a price chart of these instruments, you see a decline toward a trend line that goes back 10 or so years. But on momentum, you've blown a flat structure that goes back 10 or more years on each of them, that such that they've never dipped below the shallow level relative to their 3-year average. But they've now blown it out. So as far as I'm concerned, they're totally on fire. The only issue is what's the nature of the decline? Is it rapid? Is it multi-legged and sloppy? Is there a mini crash in there at some point, in which case rates rise rapidly? Right now, the 30-year bond, I think, could go to 4.25%, which is like 1% or more higher than it is now.
Wow.
And that would be shocking. I mean, that to a lot of... Think about this. The Murray Rothbard, who I knew back in the 1970s, was the father of modern libertarianism, and he was an economist. He wrote a book on the Great Depression, and he talked about the error that is accumulated by money distortion. It's not just, inflation, quote unquote, measured by commodities or something like that, but businessmen make decisions, families make decisions based on factors like their income or the cost of money.
Yeah,
is a major factor. And if you assume, because for so long the cost of money has been, nil, that the cost of money is going to stay low, then you've built a whole lot of decisions and committed a lot of money, assets, plans, etc., based on a false assumption. Because if it comes unwound, your whole enterprise could come unwound. Everything you've based upon that factor. And I think that's hard to define as to where it occurs, to whom it occurs, but to a lot of people and a lot of institutions. And so when that comes unwound, it's a big deal. It'll not just hit the stock market, it'll positively impact certain other areas and negatively impact other areas. Because the effect of that has been to distort prices in many markets, both upwardly and downwardly. So that the upward pricing in the S&P, for example, which was printed money, Bernanke even stated, I want to drive the stock market up.
Yeah.
Make people happy. Well, he did, and investors channeled that river of money, narrowed it, and ran it into the S&P 500 and ignored everything else. Commodities, we don't want them, we don't need commodities. And commodities went down from 2011 to 2015. once that investor preference shift is fully engaged, and I think it's engaging in phases, the smart money moves first, and other people realize what's going on, then you'll have a vast upward shift in commodities simply because that money is being moved out of one area that's been favored for 9 years into another area that's been disfavored for the last 6-7 years. And that creates big jolts. So it's going to be fun.
Well, Michael, certainly your views, and you've been consistent on this, your work has been consistent, suggesting that we're entering significant bear markets in the financial assets and stocks and bonds, and a significant bull market in commodities and precious metals. And that really runs contrary to the conventional wisdom. Everybody believes that rising interest rates are going to be a death knell for gold and for commodities. But you and I have lived long enough to remember the late 1970s when exactly the opposite was the case, right?
Yeah, that shocked everybody with orthodox views, and I think it's underway now. Underway, not pending. It's started, and we ran a chart, a simple graph bar chart of performance of gold in the S&P since the close of the year 2015, meaning all of 16, all of 17, and up through now in 18. How has gold done versus S&P? Most people would be shocked to realize the difference is about 2% or so. Mm-hmm. Everybody thinks the S&P has just outpaced everything. And here's gold, quiet, nobody even notices it, and it's barely a few percent behind the S&P in terms of its gain over the last 2 years and a quarter. So something's going on there. And I think there's a lot more to go on. And now that the stocks are being rattled pretty well, I think a lot of investor money will seek other places. And I think one of those places will be commodities. Why? Because they're behaving well,
All right, Michael, I need to ask you, because we're running out of time here, I need to ask you about something you just put out, I believe it was yesterday, a special missive you put out, 2 big tools for the big event, an introduction for future use. Could you explain that to me, because I haven't had time to think about it very much, and also to my listeners?
There were 2 charts we showed. First off, you could go back to February 2nd, prior to the week of February 5th, 6th, 7th, and 8th, 9th, which collapsed. The S&P dropped 250 points in that week. But on February 2nd, weekly close, we issued a weekend report that said the volatility is going to explode because we measured, instead of the VIX index, which measures option pricing, we measure volatility via standard deviation bandwidth readings of weekly momentum of the S&P. Now, that's a mouthful, okay? We're measuring volatility a different way, suffices to say. It's our own proprietary tool. But it gave us a buy signal, buy meaning buying volatility, as of the close of the week, February 2nd. The next week, the S&P collapsed, and volatility went through the roof. Okay. Now, when you apply that same concept to monthly readings of standard deviation of momentum as opposed to weekly, which we did then, we're nearing a level, not that close, but it wouldn't take too much more to blow out a multi-year channel on this monthly momentum standard deviation, which would indicate you not only get increased volatility short term, you're going to get it for long term, meaning we're going into a bear market. The next tool we looked at was a 3-year average oscillator of the S&P, meaning plotting the S&P versus the 3-year average, and we noted that in 2011, the European debt crisis, and in 2016, the market sold off down toward that area of the 3-year average, found footing there, and rallied. But when you look at the chart, instead of a price chart making a new high in recent years, that third wave that we saw the last few years in the S&P on the upside, above the 2013 and 14 highs, for example, in price, momentum didn't make a new high. It made a third wave looked like a head and shoulder pattern.
Yeah.
It's about 9 years wide. And it says if you ever go back through the 3-year average, you're not only down, you're going to be down for several years hard. And while the 3-year average right now is in the 2200s, next year it's going to be in the 2400s. So we ain't far away. So right now, as far as I'm concerned, the S&P is broken on its quarterly and partway on its annuals. And if it drops another that kind of percent, which is you're only talking, 100 points is about 4% now. So if you drop about 8 more percent, you're in danger of blowing a structure that's so massive that it will set the tune for the next few years. Similar to what the T-bonds have already done on their annual momentum charts. So I put out those two different charts that are very long-term, but very big implications. And we're monitoring them, and we'll update our subscribers as to when those those two indicators say, oh, it's not only are we going down, we're going down big.
All right. Well, it's the kind of work that Michael puts out on a regular basis. It's very, very worthwhile. If you're a serious investor and have some money at stake, you might want to consider subscribing. Michael comes out with stuff many times during the week that's very, very valuable. I couldn't be without it now, Michael. I want to thank you very much for sharing your thoughts with us, and look to do it again next week, hopefully.
Thank you, Jay.